So, principle 2, stopping volume. Okay, now, again, this is a difficult one to trade sometimes because you can get stopping volume and then the market can go down for some more. And Philip, we're going to talk about that because somebody in the survey said, I don't understand in a down move why you've got loads of green signals and there's no red ones. But the market fell 20 points on the S&P and all I saw was green signals. We're going to answer that question today, why that happens. But stopping volume, to stop a down move, demand has to overcome supply. As a market falls day after day, a point will be reached when the herd cannot stand the losses, so they all tend to panic at a similar time. If the price levels reached are now attractive to professional money, they will step in and they'll start buying. This activity causes a surge in volume as they buy and cover their short positions. Okay, so we're going to look here at the Dow. Now, we know that the Dow, this is the futures contract, the pound F contract, has been in a bull run. But this particular bar here was on a news release day. And look at the volume there on the bar. It was absolutely massive. We notice that the bar closes lower than the bar behind it, as you can see here. So it closes lower. This was on the 2nd of September. You'll notice on the 2nd of the month they release a lot of news, don't they, Philip? And they'll take any advantage they can. Now, there was a lot of bad news here, and yet the market continued to respond up to 10,000. It went up 700, 800 points from here. Now, what made that bar so interesting to me was not the bar itself, it was the next bar. Philip, can you just talk about that and why the next bar was really a strong indication that that was going to go up?
Well, the previous bar, you've got ultra-high volume on a very narrow spread. More important, it's on a down bar.
Just here?
No, sorry, the next one, the one you've got highlighted there, the stopping volume.
Oh, this one, yeah.
Yes.
Mm-hmm.
Now, importantly, the next bar is up.
Yeah.
And the fact the next bar is up confirms that there must have been buying on that bar, and it's has it taken out the high?
It does actually just take out the high of the previous bar. It's almost like a two-bar reversal.
Yeah, that's even more important in that case.
Yeah.
Because to do that, again, you've got effort versus result.
Yeah. Now, real good stopping volume. Now, this is something where Tom and I were looking at. Well, we're going to show you Microsoft shortly as well. We're actually in an uptrend now. Real stopping volume comes in a downtrend, doesn't it, Philip? That's where you really see it. This is actually, as it comes down, it's almost like a shakeout as well. You could call this a shakeout bar because the news was bad and yet they marked it down and the next bar was up. But it stopped any effort to move down and the uptrend actually continued. Now, this one is a much better example, I think, which is one you picked. MRK. Is that Marks? No, which one's?
Merck.
Merck. Yeah,
US stock.
Yes. Yeah, Merck. Now, I'm not familiar with the stock, but here, really nice examples here of why this stock moved up. Do you want to talk us through, really, I mean, you've got a beautiful example. You've got a nice downtrend behind you, which I can assure you was there, but I wanted you to see some of the principles here. Do you want to talk us through that, Philip?
Well, bar A, you've got, as Gavin said, you've got a down move behind you. Bar A, you've got a down bar which closes more or less in the middle. You've got a big increase in volume there, really ultra high volume. And again, the next bar is up. If we look at B, it's gone up and it's closed right on the highs. And I'd say that's gapped up as well, almost anyway.
It has, yeah.
So that shows tremendous strength, and that shows that there must be an awful lot of buying on A for it to move up that sharply. Mm-hmm. And when you get to C, you've come down, you've done a test. We haven't come right back down into the buying area of bar A, but obviously the market there is so strong that it hasn't needed to.
And bar D, what a beautiful entry.
That's a lovely entry because by then you're into an uptrend.
Yep.
And bar D, you've got a lovely new supply bar there. It's a narrow spread. Volume is pretty low, and that's an excellent entry.
And let me just be clear. Sorry, Philip. Just before I come back to you, we have made the reason after this we've made 3 higher lows.
Yes.
At least 3. That's what I said at the beginning. Remember what I just said there. 3 higher lows. Philip, correct?
Yes.
That shows that's after that amount of bullishness. Mm-hmm. That's not even going to retest very rarely.
No. That shows real strength.
And bar D would be your entry after you see that. Okay. Now, where would you put a stop there, Philip? Now, again, I always like, after I see something like that and we push through it, I put my stop usually just above the bar where we've seen the stopping volume. I don't know where some people put it in the middle on the close. It just depends what your risk reward is. Where would you put a stop there?
Well, I think that's up to the individual person, how much risk they're prepared to take.
Yeah.
I think what you have to look at when you look at something like that, when you see that amount of volume coming in, it looks a really strong at that point. If you're going across to bar D and you've got nothing to the right of you, just imagine for a minute. If you look at that, you've got to think, well, you've got all that strength now behind you. This should be a really good up move from here. So you don't want to get stopped out.
No.
Because you'd miss all of that.
Yeah.
So what you'd have to do is calculate your risk reward.
Yeah. Now, Morris asked a great question. He says, come on, now look at this. Why not enter on bar C? Morris, I'll repeat. We must make at least 3 higher lows on the bar. We didn't do that on bar C, but we did on bar D.
Bar D you did, yes.
I had 3 higher lows. Let me show you. Higher lows. I'm talking about the low of the bar. Okay, so there's your stopping volume. There's the first higher low made. There's the second one. There's the third one. Okay, here, because it's a down bar. And then finally, we come back down. The volume is lower than all pretty much the other bars, and the next bar responds up. And I would probably have my sell order in around here. My buy order around here and be taken in. But that's the reason why you don't go in on the C, because you haven't. It could easily come and retest. And there's a lot of examples of what we're showing you where the market has got so much stopping volume it just goes up.
And I think the other thing is once you've gone into your position on bar D and you've taken out the highs just to the left, you could then consider raising your stop.
Yes, absolutely.
So then you're cutting your risk right down.
Yeah. Tom, this is a great example of stopping volume followed by an immediate test and then a no supply bar. And it did produce 3 signals right under it. I've taken the signals off for the purpose of the seminar. But just to say, this was almost the same entry that I took in New York, but on a smaller time frame.
Yes, yeah.
And I jumped in there, and you'll hear me say, this is a very high probability setup. Now, I was using the diamonds to confirm the trend. I had 3 of them behind me. But I said, look, I've got serious strength behind me. In fact, it was better than that. It was climactic. It was a lovely climactic bar behind me.
There was strength behind you, but you couldn't go long because it was too early.
That's exactly what happened. I had to wait. And Morris, that's why patience, just wait, as you'll see from the video. And then, what do you call it, Tom? Your bus will arrive, you tell me.
Yes. Well, what I say is that you're looking for a VSA principle. You must fully understand it. And it's exactly the same as if you're at the bus stop. You're waiting for your bus to arrive with your number on it. You don't just dump on any bus just for sake of getting onto a bus. You wait until your bus comes along which has a number on it. And that number, of course, is a VSA principle.
Now, here's a good example. Look, now this is Citigroup. Now, you can go and follow this one now, because now we've got a stock that's had stopping volume, but it's now churning. It's going over and over and over. Tom, what's churning the stock? What does that mean?
Well, when a stock churns, very often churns while it's accumulating. You've probably seen the down move. You've probably seen some sort of stopping volume, and then the market starts churning. And you can usually see it because it has no demand on the tops and narrower spreads at the bottom, and it keeps within that trading range as it churns. They're accumulating. That's what's happening there. And then before the up move, they like to have a nice shaker. Wyckoff called a springboard, I believe.
Yeah. Now, here we can see on the chart clearly we have this terrible news about Citigroup, as we know. There's your volume. Closes off the middle, just up there. Next bar closes up, so something's going on. And the market begins to rise to this point here where we get average volume, nothing much, but then there's your no demand bar. Look, just after it, it's just where my green arrow is. And we come off, we hit a bit more supply, next bar is down, so they're not ready to mark this up yet. Now it comes back down into the area where we saw very high volume, and this time the volume's getting less at that same price level at about $3. That is a good sign there that there is some sort of support behind us. There is some potential. It is a little bit of bag. Would you say that's bag holding to the left there? It certainly looks a little bit... it's a gap down bar.
It looks a little bit like it, yes.
Yeah, it certainly would meet that criteria.
Because this is a US stock, isn't it? I'm just wondering, looking at bar B, whether the volume on that bar B has actually been withheld. at all.
Well,
I don't know how the US market works.
Probably
If that was
not.
London, I would say that's almost certainly been withheld.
Do you want to explain a little bit what you mean? Because I know you've traded these markets for 20 years, and I know that you say that sometimes you see volume doesn't make sense on one day, but if you put 2 days together, it makes total sense. So you're saying that exchange in effect could withhold the information or the volume because they know if anyone can read it, it could give them a benefit.
Well, they do it in London, I know, because they admit it. There's rules that if it's all decided according to what we call normal market size, which is the number of shares which the market makers actually have to deal in and guarantee the prices they'll deal in.
Mm-hmm.
Anything over and above that, they don't have to meet the prices which they quote.
Mm-hmm.
Now, if people want to deal in large amounts, the market makers don't want everybody else to know that, for example, they've got a large sell order they have to put onto their books.
Mm-hmm.
So what they do is they take the market order on and they do it in pieces, but they don't release. They don't have to release the volume onto the market until there's, I think it's something like 36 hours or a couple of days, depending upon the size and amount involved.
Philip, that sounds like skullduggery.
Well, it is.
Where do we buy this Citigroup stock? Where would we get it? What would we do here? We're going to wait for the churning to start to break out. Okay, Wyckoff would call it a springboard. We're coming down on lower and lower volume till eventually professional money have basically accumulated enough at a certain price and up we'll go. So we've got to take out this area here. I wouldn't even be looking at a buy on this until we take out that bar which had acted as resistance. And then, much the same as we talked about earlier, we're going to look for a test in a rising market as the market rallies. So again, we're buying the market in a rally, not in a sideways move, and we're buying it on a test or a no supply bar, which we're going to get to shortly. So when we see stopping volume, when smart money or professional money accumulate, you will see it beginning on high volume down bars, but the accumulation phase takes time, hence the churning. Now, there are times, as we've shown you, where you'll get high volume down bar and it just takes off. So you can get some that churn. Any market, even the Forex market, does the same thing, and some that will just explode. So you've got to be clear here. There are two things that will happen. Do not try to buy the bottom. That's always going to be a problem, okay, because you'll be whipsawed around. After you see stopping volume, wait for the market to drift up, then come back down into the area of stopping volume on low volume. The lower the better, as we saw on that chart. If the spread is narrow, which it was again on Citigroup, that last bar, and the market makes two higher lows within 25 bars, this confirms the long position. I actually like to see 3 higher lows, but 2 higher lows is acceptable, but 3 is really taking the risk out a little bit. Enter on any low volume down bar after this. Place on a buy order above the low volume down bar. Let the market come to you. This would be called a successful test.